Hello students. So today we take up with question number 8 of retirement of partner from your exercise textbook. Take it out everyone. Yes, look at the question. Jaya, Mamta and Smriti are the partners sharing profit and loss in the ratio of 2 by 5, 5 by 10 and 1 by 10. Very first of all, we have to convert this in a ratio. So 2 by 5, 5 by 10, 1 by 10. The denominator should be same to get the ratio. How can you make the denominator same? How can you make this 5 as 10? By multiplying it by 2 by 2. So 5 into 2 will become 10. So 2 into 2, can I say 4 by 5 into 2, 10, 5 by 10, 1 by 10. Means what is the old ratio? Actually 4 is to 5 is to 1. All of you must note down this, that old ratio is 4 is to 5 is to 1. Okay, 2 by 5, 5 by 10, 1 by 10, you convert in the same denominator. So 2 by 5, how will you make this 5 as 10? By multiplying it by 2 by 2. But you have to multiply numerator as well as denominator so that the ratio doesn't change. So basically 2 by 5 is same as 4 by 10. 5 by 10, 1 by 10, 4 is to 5 is to 1. Balance sheet of the firm as on 31/3/16 was as under. Now take on capital accounts. Let us make capital account also and current account also in this chapter. In admission of partner, when current account was given, we did not make capital account. But in this chapter, you'll make both the ledger accounts, capital account as well as current account, because retiring partner's settlement is to be done and transferred to his loan account. So current account of retiring partner will transfer to his capital and capital will transfer to his loan. I repeat, current account of retiring partner we will transfer to his capital and capital we will transfer to his loan. So here we will have to make current account also as well as capital account, and all adjustments we will do in current account only. Okay, so tick on capital and current account. General reserve we will distribute in the ratio of 4 is to 5 is to 1 between the partners, all the partners. Then bad debt reserve is not to be distributed. We have seen earlier also bad debt reserve, either you can write on liabilities side or you can minus from debtors. Both the effects are correct. Tick on goodwill. Goodwill will be distributed between the partners in old ratio. And tick on, okay, which partner has retired? Smriti has retired. Smriti means which partner? Third partner. Okay, Smriti means third partner has retired. So as third partner has retired, loan to Smriti also take it will be transferred to Smriti's current account. In this question, loan to Smriti will be transferred to her, sorry, not his, her current account. And current account of Smriti also take. Two partners, Jaya and Mamta, have credit balance of current account, they are on the liabilities side. But Smriti has debit balance of current account, it is on the asset side. Asset side means it's a debit balance of current account. Okay. Now Smriti retired on 1/4/17 as a partner. At the time of her retirement, partners decided the following adjustments. We will read and solve them. Prepare necessary accounts and balance sheet. So all of you pause the video and make the formats of revaluation account around 6 to 8 lines. Partners current account half a page. Partners capital account small only, because just current account is to be transferred to capital, then capital to loan. So 4 to 5 lines capital account is sufficient. And then balance sheet. Okay, balance sheet after retirement. So all of you can pause the video and then make these formats, and then we take up with the solution. Okay, I hope everyone has done the formats. Now be attentive. Very first we record the capital balances 2 lakh, 1 lakh and 90,000. So partners capital account, all of you write down credit side by balance brought down. Two lakh, 1 lakh and 90,000. So all of you write down 2 lakh, 1 lakh and 90,000. I hope everyone has recorded that. After capital account balances, we'll record current account balance. Jaya and Mamta have credit balance. So credit side, liability side means credit balance 26,000 and 14,000. So partners current account credit side by balance brought down. 26,000 of Jaya and 14,000 of Mamta. They have credit balance. Whereas asset side, Smriti has debit balance. Okay, Smriti has debit balance of 30,000. So in partner's current account on debit side, two balance brought down. In Smriti's column, the amount is 30,000. Okay, 30,000. It is Smriti as given in the question. Okay. Further, capital recorded, current account balance recorded. Now we transfer all the things. So journal entry for general cash and bank account we are not making, and there is no balance of cash and bank account also on the asset side. General reserve account debit, the account gets closed, and to partners capital account, here rather partners current account. Here every adjustment will be made in partners current account. So partners current account credit side, we will distribute this 70,000 in the ratio of 4:5:1. Okay, by general reserve. Now 70,000 into 4 by 10, 28,000, 5 by 10, 35,000, and 1 by 10, 7,000. Okay. And shortcut I told you left, right, left. In balance sheet it's on the left side. So in partners current account it will come on the right side. Then after general reserve we have goodwill. So the journal entry for goodwill is partners current account debit. In this question, partners current account debit to goodwill. So in partners current account debit side will distribute in the ratio of 4:5:1. Partners current account debit side to goodwill account amount 30,000 into 4 by 10, 12,000, 5 by 10, 15,000, 1 by 10, 3,000. Okay, otherwise shortcut left, right, left. This is on the right side of balance sheet. So in partners current account it will come on the left side in ratio 4:5:1. Then loan of Smriti, loan to Smriti. Okay, asset side means it is not loan borrowed from a partner, it is a loan given to a partner. So if loan is given to a partner, obviously at the time of retirement the balance payable to the partner will decrease. So loan to a partner, it's a debit balance. To close it we reverse and credit, and we transfer it to Smriti's current account debit. So you can remember the shortcut left, right, left. It's on the right side. So in partner's current account it will come on the left side to Smriti's loan account. Okay, but basically this is not a loan borrowed, but it was a loan given to Smriti, and Smriti's column 30,000. So by debiting her current account, the amount payable to Smriti will automatically decrease because firm had already given loan to Smriti. Okay, entry would be Smriti's current account debit, and loan to Smriti is a debit balance. To close it with reverse and credit. So Smriti's current account debit to loan to Smriti account. Current account balance of Smriti is a debit balance, so we have to write on the debit side 10,000. Okay, current account balance is 10,000. By mistake I have written 30,000, that is loan amount, so all of you make the correction. Smriti's current account balance is 10,000. Okay, that we have already written. Now further we go ahead with the adjustments. So all of you look at adjustment number 1. Okay, first adjustment. Smriti retired on 1/4/17 as a partner. Now 1/4/17, here 31/3/16 is given, so make it 1/4/16 everyone. Either here it should be 1/4/16 or here it must be 31/3/17. Okay. At the time of retirement, partners decided that 4,000 is outstanding for rent payable. Now outstanding for rent payable, so we will be sad. We still have to pay the money, it is outstanding. So revaluation account debit to outstanding rent. Revaluation account debit means in revaluation account we'll write on the debit side to outstanding rent. Okay, revaluation account on debit side, to outstanding rent amount is 4,000, and second effect, outstanding rent is a liability. Already there is no such liability on the liability side, so balance sheet on liability side will record new liability of outstanding rent 4,000. Okay, revaluation account debit to outstanding rent, revaluation account debit, so in revaluation account on debit side, and to outstanding rent will come on the liability side 4,000. Next, interest on investment receivable 2,500. Now interest on investment is receivable, so that is, we should be happy about it. It's a profit for the firm, so we should be happy about it. We have to still receive the money. So outstanding income account debit to revaluation. To revaluation means revaluation account on credit side by interest receivable or by outstanding interest account. Okay, by interest receivable or by outstanding interest account, and amount is 2,500, and second effect will come on the asset side, interest receivable or outstanding interest of 2,500. Interest receivable account debit will come on the asset side, any receivable is an asset, 2,500. Then next adjustment, investment to be sold for rupees 35,000. Okay, investment to be sold for 35,000. Investments are 33,000 and put tick on them, to be sold for 35,000. So here cash account debit 35,000. Okay, cash comes in, debit what comes in, investment goes out, credit what goes out, to investments account 33,000, and profit of 2,000 will be going to revaluation account. So in revaluation account on credit side, by investments account with profit of 2,000. Okay, by investments account with the profit of 2,000, 33,000 investments now. So selling for, we are selling it for 35,000, so we should be happy with it. Okay, we should be happy that investments value has gone up by 2,000. So investment first entry would be, two entries can be passed. First, investment account debit to revaluation. First we increase its value by 2,000 and then we sell it for 35,000. So cash account debit to investments account with 35,000. Okay, two entries will come. First we increase its value by 2,000, so investment account debit to revaluation. So investment account debit to revaluation means revaluation on credit side, and then cash account debit means in asset side cash will come. There is no cash already in the balance sheet and we have not made its ledger also. So separately all of you write cash on the asset side 35,000. And then two investments means investments account gets closed. Okay, investment is 33,000. You all can see that you debit it with 2,000, so it becomes 35,000. Now you credit with 35,000, so 33,000 plus 2,000, 35,000 investments account gets closed. Okay, why I have passed two single entries? The reason, in revaluation account credit side will not write by cash account. If you pass a combined entry, cash 35,000, to investment 33,000, then to revaluation 2,000, then by mistake in revaluation credit side you may write by cash. But in revaluation credit side you write by investments only. Investments value has gone up by 2,000. Then you sell it for 35,000. So cash 35,000 comes on the asset side, and then to investment means asset, investment account gets closed. Next, goodwill of the firm is valued at rupees 2 lakhs. Now before we take up with goodwill, we'll have to make the workings and find the gain ratio. In adjustment 5, new ratio, Jaya and Mamta will share future profit in the ratio of 1:1. New ratio is given as 1:1. So first we make the workings and find the gain ratio. After the balance sheet, all of you make the workings. Working note 1. Jaya, Mamta and Smriti. The The old ratio is 4:5:1. 4/10, 1/10, 5/10. Then new ratio is given as 1:1. Okay, Smriti has retired, and between Jaya and Mamta the new ratio is 1:1. That is 1/2 and 1/2. Now gain ratio we obtain as new ratio minus old ratio. So for Jaya, new ratio 1/2 minus old ratio 4/10. For Mamta, new ratio 1/2 minus old ratio 5/10. Now LCM is 10. 10 divided by 2, 5 into 1, 5 minus 10 divided by 10, 1 into 4, 4. For Mamta, 10 divided by 2, 5 into 1, 5 minus 10 divided by 10, 1 into 5, 5. So 5 minus 4, 1/10, and 5 minus 5, 0/10. In short, the gain ratio is 1:0. So entire goodwill share will be borne only by Jaya. Okay, entire goodwill share to be given to the retiring partner Smriti will be borne only by Jaya. So second working note for goodwill, what entry we will pass? The entry is remaining partners capital account debit in gain ratio. Since only Jaya is gaining, so in remaining partners will debit only Jaya's which account? Which account? Current account. Okay, current account, not capital. In this question, current account. Remaining partners capital or current account debit to retiring partner, that is Smriti's current account. Again, current account. Okay, to Smriti's current account. Now first, retiring partners amount, that is goodwill's value is given in the question as 2 lakhs and retiring partners Smriti's share is 1/10. So goodwill into retiring partners share, that is 2 lakhs into 1/10, that will be 20,000. Okay, Smriti's current account with 20,000 and same amount entirely will go to Jaya. But even in case if you find it by the gain share 1/10, again you will get same amount only 2 lakh into 1/10, 20,000. Since only one partner is gaining, entire 20,000 to be paid to Smriti, payable to Smriti will be borne by Jaya. Now Jaya's current account debit, so in partner's current account we'll write it on debit side. Opposite account to Smriti's current account. In bracket goodwill. In Jaya's column 20,000. And to Smriti's current account, so in partner's current account credit side, opposite account by Jaya's current account in bracket goodwill. And amount will come in Smriti's column 20,000. Okay, so this is the entry for goodwill. All of you can pause and rewind the video if there is any confusion. Jaya and Mamta will share profit in future profit in 1:1 ratio, that is new ratio we have already used in finding the gain ratio. Now untaked items, creditors are 90,000, so liability side all of you write down creditors 90,000. Then general reserve recorded, current accounts recorded, capitals recorded, bad debt reserve 10,000. As I said, either you can write bad debt reserve on the liability side or you can minus it from debtors. Both the effects are correct. Okay, here there is no adjustment, so we keep it untouched. As it is, as given in the question, we write it on liability side itself. Then further, asset side we have goodwill, already recorded building 2,82,000 as it is. Building 2,82,000. Then after building we have machinery 1,45,000 as it is. Machinery 1,45,000. Then after machinery we have investments are being sold, so they will not come in the balance sheet. Stock 20,000 as it is. Okay, stock 20,000. Then after stock we have debtors 50,000 as it is. Debtors 50,000. Then after debtors we have loan to Smriti is transferred to our current account. Current account is also recorded as the balance. So all assets and liabilities are recorded. Now normal balancing, credit side is more, 4,500. Same total on both the sides, 4,500 minus 4,000. So 500 balance will remain to partner's current account. Okay, we will be transferring it to partner's current account, and all partners will distribute Jaya, Mamta and Smriti in old ratio 4:5:1. So 500 into 4 by 10 200, 5 by 10 250, 1 by 10 50. Okay, opposite side in partner's current account by revaluation account. $200, $250 and $50. Now, very first you'll balance retiring partner Smriti and transfer to her capital account. Okay, Smriti's current account will be transferred to her capital account, then her capital will be transferred to loan. Remaining partners will be shown as balances in the balance sheet. But retiring partner Smriti's balance first you will do and transfer to her capital account, then capital will go to loan. You all can see that debit side is more. 30 plus 10, 40 plus 3, 43,000. So 43,000 on both the sides. 43,000 minus 27,050. So 15,950. Okay, 23,000 minus 27,050. So 15,950. By Smriti's capital account, you'll transfer the balance to Smriti's capital in bracket balancing figure. Okay, by Smriti's capital account in bracket balancing figure. Opposite side in partner's capital you'll write on debit side to Smriti's current account. Okay, to Smriti's current account. What amount? Now 15,950 in Smriti's column, and then Smriti's balance final will go to her loan. So credit side 90,000, minus 15,950, so 74,050 to Smriti's loan account. Okay, so final balance payable to her after adjusting her past loan, current account, all the things is 74,050, balancing figure. This Smriti's loan 74,050 will come on the liabilities side. Smriti's loan 74050. Now remaining partners will do the balancing and write the balances in balance sheet. So Jaya and Mamta, as you can see, credit side is only more, so their closing balances will come on the liabilities side. Okay, 26 plus 28, so 20, 40, 46, 54, 200. For Mamta 14, 49, 250. $54, 200. 49, 250. Now 54, 200 minus 32,000, so 22,200. 49, 250 minus 15,000, so 34,250. 2 balance carried down. Now these both will come on the liability side. Partners current account 22,200 and 34,250. Okay, they'll come under the heading current account. Jaya 22,200. Mamta 34,250. So total 56,450. Okay, they'll come on the liability side 22,200 and 34,250. Now capital balances, Smriti has retired. So Jaya and Mamta's capital balances will come on the liability side 2 lakh and 1 lakh. Balance also 2 lakh and 1 lakh. Two balance carried down. Liability side capitals. Jaya 2 lakh. Mamta 1 lakh. Total 3 lakhs. Now we will do the total of balance sheet. So 3 lakh, 390, 440, 450, 520, 524, 528, 534, 500. 5,34,500 we need to verify. Does it come same on both the sides or not? All of you can do it in the calculator on your own. If we do asset side, then 2,82,000, 382, 420, 427, 477, 497, 527, 529, 500, 280, 380, 420, 460, 444, 5 lakh, 44,500. Must be coming same 534,500. Okay, right? So all of you must be clear with this question. All of you solve it properly, and I suggest that you all can pause the video and do it again on your own and resolve the entire question again on your own if required, and again play the video and check it whether you've done it correct or not. Okay, so that'll be all for this lecture. Bye everyone, take care, see you in the next lecture. Bye.